Hi, this is Jim Cunningham, and we're going to cover income tax reduction strategies for professionals and 1099 earners. If this is you, you should watch this because it's a great opportunity to save on taxes. Many people just don't do basic tax hygiene. They don't, it's like washing your hands before you put your contacts in or something, right? It's just basic stuff that should be done that can really save you thousands and thousands of dollars. And you can think of this as a trip to Tahiti in an overwater bungalow, maybe once or twice a year, I guess, depending on what hotel you go to. But regardless of your financial knowledge, and this is really important, there probably is a way that you can pay less tax and keep more of what you earn. I'm Jim Cunningham. I'm a partner at Cunningham Legal. I have over 25 years experience as a lawyer. We have offices throughout California, and I'm a certified specialist in estate planning, trust, and probate law, a real estate broker, securities, and insurance licensed, and I'm also a pilot. This is our team of lawyers, and you see here Rochelle Lee Warner. She's the managing partner of the firm, and our other associate attorneys. Disclaimer, I'm going to be talking about a lot of stuff. Just don't take this and go do a bunch of stuff on your own having listened to this. This is not legal advice. This is information only, and really, I mean it, information only. So let's talk about income tax reduction strategy number one. And I would put this in the sort of super basic, set up a retirement plan. A lot of people don't, and it really does make sense to consider setting up a retirement plan. And we're going to talk kind of about 3 retirement plans because these are all kind of related. And then there'll be a couple of others that we'll cover in a couple more slides. So if you have no employees and you're doing your thing, you're doing your gig, you can do a solo 401k, and a solo 401k allows you to put up to $66,000 a year into a retirement plan if you're under 50 and $73,500 if you're over 50. So this is for no employees. There is something called a mega backdoor Roth option. What is that? You can roll up all this stuff into a Roth. So very powerful strategy. Now, we'll talk a little bit about the difference between a Roth and a regular IRA, but know as we go through the materials here that a Roth may be better suited for you, or it might not be. It just depends kind of on your trajectory and your own situation. The SEP IRA is typically for people who kind of have employees, right? And a SEP IRA allows you to put 25% of compensation up to $66,000. Now, this requires you to have $300,000 effectively in compensation. So you have to have enough net income to hit that number. And you must have a corporate entity. So this does not work for sole proprietorships. You must have a corporation, LLC, or partnership to do this. And if you're self-employed and unincorporated, you're capped at 20% of your comp. So look, I don't make the rules. I don't know why they wrote it this way. It seems a little stingy to me, but the rules are the rules. A simple IRA it lets you contribute $15,500 if you're under 50 and $19,000 if you're over 50. Should you consider a traditional or Roth IRA? What makes sense for you? Now, you have to decide this ultimately because this is your money. This is your taxes. It's your life. I really firmly believe that. Clients should educate themselves. People who watch these videos should educate themselves. But think about this. A traditional IRA is not a Roth IRA. So there's traditional and Roth. Traditional, you contribute pre-tax dollars. So what that means is if you did contribute $73,500, you're not paying federal or state income tax on that $73,500. Now that's a big tax savings for many people, right? I mean, think about how much you pay in tax and think about your tax rate. So you might be paying, state and federal combined, let's say 40%. If you put 70,000 in, you're paying 28,000 less in taxes. That money that you would have otherwise paid in tax goes into that retirement account. That's one way to look at it. The growth is tax deferred, not tax free. It's very important to understand when you hit a certain age, you have mandatory distributions. Now, there was Secure Act 2.0, which we'll be covering later this year in our webinars, but it's very important to understand that the cows come home on this one, right? The tax cows come home, and those are not good cows. Those are like bad cows, okay? There's mad cows and there's bad cows. These are the bad cows. When you defer taxes, that money grows. Let's say you put 100,000 in over the course of a few years. And when you hit that time where it's time to withdraw those funds, let's say it's worth 500,000. Every dollar that comes out of that 500,000, somebody has to pay income tax on. Now, you're going to pay it if you're the one taking it out. If you die and leave that to somebody else, assuming that is not a charity, right? A human, then you're going to have to, that person will have to pay tax on that money. So this is a fundamentally a tax deferral strategy. So don't pay now, pay later. That makes sense for a lot of people. The Roth IRA, and you may have heard of a Roth, you contribute after tax funds. So you do have to pay tax on those funds. But depending on your income level, if you're not paying a lot of income tax, it might make sense to do a Roth. If you're not itemizing your deductions, and we've covered this in previous webinars, but if you don't itemize your deductions, it doesn't make sense to do a traditional IRA because you're not going to get a deduction anyway. So it would make sense to look at the Roth. So again, I think this is something where you have to look at the math. You have to look at the numbers to make it work. This is something where you should get professional advice, and we'll talk about that. In a Roth, you contribute after-tax funds. The growth is tax-free. Not only is it tax-deferred, but when that money comes out, there's no income tax on that money. You can withdraw the tax-free funds without a schedule. So if this is your IRA that you create for your lifetime, you do not have to take that money out at any time in your life, at least under current law, right? You don't have to take that out of that account at any time. When you pass away and people inherit that Roth, they are then subject to a distribution schedule, for lack of a better term. Now, you may say, well, that's not a big deal because they're not paying income tax. But remember, right now, for most people, that term's about 10 years. That money continues to grow tax-free for that 10-year period. So very important to consider, who am I leaving this IRA to? Many of our clients choose to create an IRA legacy trust. Now, that's something that's a name we've given to a special type of trust for retirement accounts. What that does is it puts some guardrails up against the retirement account, because you really should not be leaving this to your living trust. That's a very complex, bad idea. Reasonable minds differ on this. Some lawyers say, oh, it's fine, Jim, I don't know what you're talking about. But I kind of presume that people are going to mess things up as time goes by, right? But it's very important to understand sometimes it's good to have a wrapper around that traditional IRA or that traditional Roth rather than leaving it to just an individual person. Cash balance pension plan is another one. Now, this is a pension plan. So we've been talking about SEP IRAs, solo 401k. Those are defined contribution plans. Defined contribution, meaning you are putting in $66,000 a year or whatever it is, and that account can grow to whatever size, big or small, and you're going to take distributions out at a certain period of time. A cash balance pension plan is something different. This is a defined benefit plan. So this is based on interest rates and it's based on your age. Now, what is great about this is you can contribute dollars pre-tax. The growth is tax deferred. So right off out of the gate, it looks kind of like a traditional IRA. It's taxed as income when you take that money out. So as far as we've covered now, it kind of looks like the traditional IRA, but remember the cap is $66,000 or $73,500. You do have mandatory distributions like a traditional IRA, but you can put away up to $300,000 a year for a total of $2.8 million. Now, this is huge, all right? So this is typically for people, a lot of physicians do this, and this is why we geared this toward professionals. Many physicians, lawyers, people who might not have a lot of employees, right? You might be a physician, you might be making $1 million a year, and you're contracted with a hospital. You don't have any employees. It's just you, right? This is a great opportunity to look at if you're a high income earning professional, to look at a cash balance pension plan. This is IRS approved. So this isn't a gimmick. It's not a trick, but it does require expert care and feeding. And this is something where you certainly want to work with a lawyer and a financial advisor and a CPA, because as sexy as this looks, deducting $300,000 from your income and saving $150 in California, it is not for everyone. Okay. So it really does require a professional analysis. There's another method of retirement plans, if you will. It's called a California Private Retirement Plan. Now, a California Private Retirement Plan was created in 1970, and this is under the Code of Civil Procedure, section 704.115. So if you want to look that up, I would encourage you to take a look at it. This was passed 4 years before ERISA, which is the federal legislation that created IRAs and 401ks. And so what happened in California a lot of times is does things first, right? Is kind of ahead of the pack. And California said, gee, wouldn't it be nice to have a structure where people could put assets into a private retirement plan and have that protected from creditors, right? Like a 401k is protected from creditors. So that was California's version, later adopted by the federal government. The only thing is this is limited to California residents. So a lot of people who leave California kind of leave this opportunity behind. This can be protected 100% from creditors and even bankruptcy creditors. There are no IRS filings. There's no requirement to include employees, and there's no restriction on your investment types, but there are no income tax benefits. Okay. That's the big kicker. Now, this can be coupled with other tax strategies, and that's a very important part of our service offering at our law firm is mitigating income taxes, right? Using tax credits, tax deductions, and tax deferrals. But there are a lot of things that you can couple with this to get an appropriate result. I will say that this is probably the most expensive in terms of care and feeding. When you kind of rank 401k, SEP, cash balance pension plan, this tends to be the pricier type of retirement plan. And again, it has to be right for you. It's got to be, the juice has to be worth the squeeze in the sense that, this is a more complex plan, but for many people, they love this plan because it does not offer the same attributes as the other plans, or not enough of them. By the way, many of these you can stack on each other. So you can stack a California private retirement plan on these other types of plans. So where do you get help? Like, who do you turn to? You watch this video, you go, oh my gosh, my head's exploding. What do I do? Who do I call on this? Well, I would say working with a certified financial planner, that professional will help you determine an appropriate vehicle. Of the vehicles we've discussed, which one's appropriate for you, and they can also give you ongoing investment counsel. Lawyers also counsel the client. The lawyers are the ones who create, or should be the ones who create, the corporate entity. We facilitate the care and feeding. Many times on the A team, the lawyer is essentially the project manager. And so we're tracking things. It's kind of native to a lawyer's role in general. Like, we calendar things and we follow up and we pay attention and we organize meetings. And that's really kind of a legal role, making sure all the I's are dotted and T's are crossed. We're also a resource for clients in the future, a law firm. CPA, very, very important. The CPA is typically involved in the compliance role, the annual corporate filings, and preparing the personal returns for the client as well. So I would recommend that, if you're a professional and you've got a corporate return and a personal return, you want to make sure, if you use separate CPAs or separate firms, which does sometimes happen, you want those two talking to each other. And by the way, just a little bit of a tip: if you make a lot of money, you should be talking to your advisors at least before the end of the year. I talk to mine quarterly. Okay. So that's something that I pay close attention to, because California has a big state income tax. So this is an example of the A team. And here's me with my book, Savvy Estate Planning, which you can pick up on Amazon, which kind of covers fundamentals, let's say, of estate planning, like who's going to make decisions for you, and do you want to protect what you're leaving your kids from future ex-sons-in-law and future ex-daughters-in-law. So that's the A team, and the A team consists of typically the CPA, attorney, and financial advisor. Well, income tax reduction strategy number 2, business structure. Business structure matters, okay? The big one in California and other states have this, what we call SALT workaround, S-A-L-T, state and local tax workaround. You can, as a business owner, with an entity, and this is really important because this does not work for sole proprietors, does not work for something called a disregarded entity. You have to have 2 in there. So you can't just have one person owning all the shares. How do you deduct all California state income tax under AB 150? Well, here's an example. Betty, a physician, earns $1 million a year. She creates Betty Inc. in 2023, and that's a professional. That's what we call a professional corporation. So there are regular corporations, and then there are professional corporations that have additional requirements. Betty pays her California state income tax at a discounted flat rate of 9.3%. So believe it or not, the state is discounting the taxes that are paid. Now, the reason I use $1 million is because it kind of has to be a big number for this to make sense, but even smaller numbers do make sense. But again, you've got to do the math. But Betty pays tax at a discounted rate of 9.3% instead of paying $116,907, which in 2023 would be her state income tax bill. So that $93,000 is deducted from her federal income tax. This is really important because otherwise she's limited to $10,000 of a deduction. This saves Betty over $34,000 in federal income tax and $23,000 in state income tax. So by creating a corporation and Betty running this money through a corporation, she's going to save $58,000. She also saves, if she takes a salary and we'll cover this in a few more slides. If she takes a salary and pays herself a dividend, she's going to save another 2.3% in taxes. So this does require, I will tell you, this requires a lawyer and a CPA working together. Physicians can only do corporations. They cannot do LLCs. So California has some pretty strict rules on that. So don't just blindly go out and do this. And then you have to register it with the Department of Consumer Affairs. So there's a lot of things you have to do. But if you're a physician and you're making a lot of money and you're not incorporated, you're leaving money on the table. Income tax reduction strategy number 3, business owner tax break. So this is really, really big. First of all, what is a business? I think, there's a classical book definition, but basically it's an activity for profit. Now, sure, you've got nonprofits if it's for a mission or a social cause, but what we're talking about here is a business that generates a profit that pays a tax. Now, businesses have several forms. You can be a sole proprietorship. It's where you have nothing. It's just you mowing lawns or whatever it is, right? You can have a partnership. It's 2 people. You can have a corporation or a limited liability company, and we'll talk about each of these. So the real big headline on this is if you have qualified business income, which basically means you're not a professional, you're not in financial services, and you're not selling your likeness as sort of a product endorsement, you can deduct 20% of your business income. This is really cool. Now, this was part of the 2017 Tax Act under the Trump administration. And I'm not making a political statement. I'm just saying when it happened. Okay. And this is the Tax Cuts and Jobs Act. And this allows non-corporate, meaning non-C corporation. This does work with an S corporation, and I'll explain to you what that is in a little bit. This deducts up to 20% of qualified business income. So Hal, a plumbing contractor, earns $1 million a year. He can deduct 20% of that $1 million income, okay? And he reduces his federal income tax by $74,000. This is a big, big, big deal, okay? By the way, plumbing contractors, last time I read, the average plumber makes about $100,000 a year. The average plumbing contractor makes $500,000 a year. Hal must be a really good plumbing contractor, okay? That's Hal. Let's look at Wanda. Wanda, a physician, earns $364,200 a year. Now, that is a very specific number. She's married, filing jointly, and she can deduct 20% and save $17,000. But if she makes over $464,000, there is no deduction. And this applies to all other classes of professionals. Now, the reality is many physicians make over that $460,000 mark, so they're not getting this 20% deduction. But it does sort of beg the question, how much should you work? What are the tax benefits? And these are personal questions that you've got to decide for yourself. There are a lot of deductions, okay? Businesses can deduct expenses, and, to highlight some, business meals. One sort of hack is if you go out make sure that if you go out on a business meal, you're going with somebody and talking about business. That can be a deductible expenditure. Again, I'm going to couch this in can be. You got to talk to your tax advisor. Work-related car use. Do you take the mileage? Do you take the cost of the car? And then how do you track personal use? Phone, professional service fees. That's an important one. Child and dependent care is a really big one. So many times you can deduct those expenses. Retirement contributions, as you've seen, you can get higher contribution limits if you have a corporate structure, and then client and employee entertainment. So all very, very important deductions. So recap the 3 key elements in planning. Number 1, set up a retirement plan. Number 2, look at your business structure. It can make sense to operate your business as a corporation, partnership, or LLC. It just depends on the context. And lawful methods, frankly, do exist for reducing your taxes. This is not tax cheating. These aren't gimmicks or tax scams. These are basic tax hygiene. And I would pay very close attention to deductions, and you want to keep good records on that. So how do you get an A-team? Well, we talked about getting an A-team, right? Assembling the CPA, attorney, financial advisor. I would suggest that they all work together. If you don't have an A-team, if you're like, Jim, I don't have anyone, we can certainly help you with that. We work with lawyers, financial advisors, and CPAs. We are, right? We are lawyers, but many of our clients have additional lawyers, right? They might have a lawyer for their company or other legal counsel, and we certainly work with them as well. But our team is certainly ready to work with you. If you don't have someone, we can certainly make recommendations to people who are accepting clients. And that's really important because many CPAs are no longer accepting new clients or only certain types of clients. So that's really important to understand. And it's okay to educate yourself. You're watching this video, or you're on this webinar. It's okay to educate yourself, but I would caution, this is not a do-it-yourself project. And even, by the way, even if you're a lawyer setting this up, you should consult with a lawyer, CPA, financial advisor. Don't try and do this on your own, because you don't really, this is not something you want to mess up. So you absolutely want to get your A team. But now I want to shift a little bit. I want to talk about if you own a business and real estate. And I'll tell you, I see people making a lot of mistakes on this. I see people owning real estate in a corporation, which is a really bad idea. But we're going to do an example of a McDonald's. So Hal and Wanda own a McDonald's, and what they do is they have separated out the operation of the business from the ownership of the dirt and the structure of the McDonald's itself. So visualize a McDonald's. Now, you may drive by them, and you may drive by them and pull through the drive-through and order McDonald's. But even if you never go to McDonald's, you've seen them, and you probably see them daily, right? If you're out in the world. So they own a McDonald's, and they own the land, and they own the building, and they also own the business that's going on inside of that structure. And the business is typically going to be taxed as an S corporation. A lot of times these are corporations. They're taxed as an S corporation. Many times we do not set it up as an LLC because there is a gross receipts tax associated with that. So, but a lot of times the operating business is a corporation. And then the entity is an LLC typically that owns the property, and that is taxed as a partnership. So that's very, very important to understand. There's a big difference when you're talking about an operating business versus a capital asset. Many of the capital assets are held in a partnership structure or sometimes a disregarded entity, and I'll get to that in a little bit. Hal and Wanda take a salary from the McDonald's, and they also take dividends. So this McDonald's is generating a return. They do take a salary, and they're also getting the profits. They're taking the form of a dividend as opposed to compensation, and we'll see why that's really important. And then when Hal dies, Wanda gets a step up in basis under Internal Revenue Code Section 754 on the land, and she can sell the land free of capital gains tax, the land and the structure. So that is one really important reason. If you're looking at real estate, I would suggest you look really hard at the partnership structure, because you do have this, certainly in California, if it's community property, you get a full adjusted cost basis. So if they maybe paid $500,000 for the building and it's now worth $5 million, Wanda can sell that asset for $5 million and not pay any capital gains tax. So that's a really big deal. And so you've got kind of two halves of this. You've got the S Corp ownership structure, and the S Corp, again, operates the business. It contains the liability, the employer liability. And I cannot tell you, I cannot understate the liability that you have employing people, especially in the great state of California. Employers have lots of duties and employees have lots of rights. And that's kind of what it is, okay? Employees have hardly any duties, and employers have hardly any rights. So it's really skewed in favor of the worker. We can debate whether that's good or bad, but I'm just talking about reality here. But Hal and Wanda's trust owns the shares of the S Corp. Now, Hal and Wanda take salaries of $100,000. Hal and Wanda get distributions of $900,000. They can deduct $180,000 in income. So on their dividends, they can deduct that, the non-W-2 comp, and that saves $67,000. They can deduct their California state income tax because they pay it from their S Corp under AB 150, and that saves them another $35,000. And they avoid 3.8% Medicare tax on the $900,000 in dividends, but then they have to pay 1.5% on the basically California's tax on profits on an S Corp. But all in all, they're saving $122,000 a year in income tax. So if they're not paying attention, they're overpaying by $122,000. If they're paying attention, they're saving $122,000. And that's a lot of trips to Tahiti, okay, in those overwater bungalows, or maybe a really great trip. Maybe even a private jet. I don't know. It depends on how they want to spend their tax savings. And then the LLC owns the building and owns the dirt, the land under the building and the structure, and then rents it to the S Corp. That's how that works. So that's how the two are tied together. So the S Corporation rents the building, and Hal and Wanda's trust owns the membership units of the LLC. I would say this is a very common basic. This is not uncommon. It's not weird. The IRS would look at this and go, okay, there's nothing weird going on here. Too many people don't do this though, right? They might own that property individually, or they might not have a corporation for their business. And I think you're missing out on a lot of tax opportunities. So we've done previous webinars on this. We've done business owners' key estate and tax planning issues. We've also done tax and retirement strategies for business owners and how to protect assets and cut taxes. So those links are in the chat, and I would recommend that you take a look at those. So Ashley's just put those in the chat. If you're looking at this on YouTube, then those are also on our YouTube as well. Income tax reduction strategy number 4, professional tax planning. So very near and dear to my heart. Warning, this is complicated, and it's a good idea to seek professional help. Tax laws, even if you're in the industry of taxes, right? And of all people you would know, the regulations are complex, and it's a good idea to consult with people who know what they're doing so you don't step in it, right? And you want to make sure you take advantage of all the tax savings. And again, I'm not talking gimmicks. I'm not talking tax scams. I'm talking basic structure that reduces your overall tax bill. And a lot of people just aren't aware of this. They go, well, I guess the taxes are going to be the same no matter what you do. That's just simply not true. Okay. This is why CPAs and lawyers and financial advisors are busy with clients. It's because we're adding value and the client ends up ahead. But you do need an A team, right? And that's typically going to be your lawyer, your CPA, and your financial advisor, not the A team from the 1980s. So professional tax planning. So should you be a corporation, should you be a partnership? There are a lot of reasons why you would be a corporation and a lot of reasons why you would be a partnership. The C Corp versus the S Corp, what's the difference? Apple is a C Corp, meaning Apple pays taxes at the corporate level, and then when you receive those dividends, you're paying those individually. An S corporation does not pay tax at the corporate level, except for the California 1.5% tax on profits. A general partnership versus a limited partnership. A general partnership is just two people coming together saying, hey, let's do a business. A limited liability partnership is what you're going to see in the professional space. And that is where you have multiple professionals coming together, forming a partnership. But the problem in a traditional general partnership is everyone's liable for everyone else's negligence, right? Malpractice, whatever it is in that professional space. A limited liability partnership allows you to have multiple partners, but limit your liability to that one person. So that's very, very important. And most law firms have, if they were general partners, once the limited liability partnership statute was passed, most became limited liability partnerships. You can also do a partnership of S corporations. So you can kind of blend the best of everything. So you can have a partnership, a limited liability partnership, maybe you have 10 partners. Each of the 10 partners has their own respective S corporation for a variety of benefits. So that's something else that I see many professionals doing. Something just kind of on a very high level, licensed professionals generally cannot operate as LLCs in California. Broadly speaking, physicians, lawyers, real estate brokers. Now, could you be a real estate agent and be an LLC? Yes, for some reason they say that's okay. You just cannot be a real estate broker and be an LLC. So something to think about if you're in the real estate space and you're going to incorporate, you're going to have to go the corporate route if you're a broker versus an individual real estate agent. You can do the LLC. These things that are kind of particular to professionals. Many professionals do travel and they stay in hotels and they attend offsite meetings. A good friend of mine, he says, hey, we're always going to eat in the hotel because that goes on the hotel bill and that's a lodging bill and you're not subject to the 50% meals and entertainment. I don't know. I'm not telling you to do that. I'm just saying that's what many people do. You can deduct the cost of an automobile instead of the mileage rate, but you do have to have a W-2 for personal use. So meaning instead of that 65 cents a mile you're getting, you can have the business pay for the automobile and the maintenance and the repairs, and then you just have to carve out your personal use of that asset. You can also hire your spouse, and this is really important. If you pay at least $3,000 a year, you can qualify for minimal Social Security benefits. So if you're a professional and you own your own gig, and you have a spouse who's not receiving a paycheck, really think about adding that spouse to get a minimal salary, or even more, because that spouse can also maybe do a solo 401k, or maybe do a SEP or a simple or a 401k, whatever it is that you can put the spouse on to save more for retirement. And then, if your kids have earned income, you can put money into a Roth for your children. So this is kind of interesting. Let's say your kid's making $10,000 a year. I don't know, working at McDonald's, working at Hal and Wanda's McDonald's. And that kid kind of doesn't spends the money or whatever, you can put 6,000 into a Roth for that kid. So it's kind of cool. And that is under the $17,000 gift exemption, but it's a nice way to build a legacy for your children. And the kids can also withdraw that money tax-free to pay for college. And you can also support charitable organizations with appreciated gifts. So question, Anonymous asks, as it relates to both this webinar topic and otherwise, do you have any comments about the wealth tax legislation introduced in California last week? And do you have a sense the high net worth people to which the bill is targeted is the tip of the iceberg and the state's politicians wish to go farther down the wealth spectrum? Yeah, you know what? I'm going to tell you, the people who know, I know them, taxes are going up. If you don't think taxes are going up, I think you're kidding yourself. The government has put so much money into the economy. They have to get it out somehow. And that is one method. I'm not saying I agree or disagree with it. I have not had a chance to look at it. I did see the headline on the news about California proposing higher income taxes and potentially a wealth tax. Who knows, right? But I think you need to prepare yourself. If you're watching this, you really need to prepare yourself. The government is going to be seeking more tax revenue when you look at the shrinking baby boomers, right? They're exiting the workforce. And this is a lot of demographics. They're exiting the workforce and they're going on Social Security. I mean, when you start looking at the big trends, I see taxes going up. And that's what I'm saying. People in the know, everyone is presuming that taxes will be going up. When? I don't know. But another thing, this is a bit longer range. Create a business succession plan. Guess what? One day you're going to stop working. It's going to happen, right? If you know you're going to exit, it makes sense at least 5 years or more. And I would say maybe even 8. If you're thinking, you know, I'm going to retire, I'm going to sell my thing, I'm going to close it, whatever it is, please give your A team, your CPA, your attorney, your financial advisor enough lead time, because sometimes you might need to do an entity conversion. You might need to convert from an S corporation to, I don't know, something else, a partnership, a sole proprietorship. I don't know. But you need to understand that there are a lot of tax consequences that are dependent on the type of entity that you have. So I would say if you're 55 and you're going to quit working at 65, you need to start paying attention to this. Otherwise, you're just going to end up paying a lot more tax. I mean, who wants to do that? We're paying enough tax already. So again, we've got previous webinars that are available on our YouTube page. We've got key estate planning issues for business owners and crucial tax and retirement strategies for business owners, and how to protect assets and cut taxes. Like, who wouldn't want that, right? Let's talk about income tax reduction strategy number 5. Stay informed. Well, by watching our webinars and subscribing to our YouTube, and click the little bell when you subscribe to YouTube. If you're watching this on YouTube, click subscribe, and there's a little bell on there, and you'll be alerted when we post a new webinar. And we typically post our webinars at 6 p.m. Pacific time on Thursdays. So that's just know that those are coming out every Thursday. But you should be keep updated with the tax laws and regulations. We just had Secure Act 2.0. That's changing retirement plans. It's changing retirement plans starting pretty much in 2024. So if you're a business owner, you need to pay attention to this before you just give people raises, because we're going through this wage inflation. Guess what? There are requirements where you're going to have to provide more retirement savings. That's on the horizon. And that goes to the point of the taxes. You know, the government says, oh, you're a business owner. You need to help your employees save more for retirement. So we're going to make you pay them more to save that money for retirement. And that is, I would say, a method of taxation. And taxation, you can define it as the government taking money from you, right? I mean, that's kind of what they do with taxes. You have to give it voluntarily or you're going to go to jail. So subscribe to our YouTube channel, subscribe to our newsletter. You can go to our website, Cunningham Legal, and subscribe to our newsletter there. We do have office locations throughout California, and in Northern California and Southern California, in the Bay Area capital region, which is Sacramento, Auburn, as well as the LA area, Pasadena, and Westlake Village. When you call us, and please do call us, when you call or schedule online, you're going to talk with one of our client specialists. So not an attorney. So it's not like calling the FBI where the FBI agent picks up the phone. These are not attorneys who are picking up the phone. These are non-lawyers. Please let us know if you want to update or create an estate plan, like, or a corporation or whatever it is, or if somebody's passed away. So that's kind of, we know which way to go. But if you want to do something for you, then let them know. And if you say, hey, I'm calling because somebody's, become incapacitated or passed away, please let us know and tell us your goals. If you say, hey, I need to set up a professional corporation, I need some tax planning advice, please let them know and we can route you to the right people. Please don't ask for pricing. Only attorneys can quote legal fees, and don't ask for legal advice because only attorneys can dispense legal advice. And the goal of the call is to see if it's a right fit, number one, and then also set a time to speak with the lawyer. So that's kind of the point of the first call. Again, subscribe to our YouTube channel, very easy, and stay abreast of all the things that are happening. And if you're a fan of ours, please review us on Google. We really appreciate those Google reviews. Next week, we have how do trusts work? What happens after death or incapacity? Like, you've set up this trust. What happens? How does this thing work? Does it do things on its own? Does it happen automatically? Short answer, no. There's a lot of stuff to do. And especially, this is a great webinar to invite somebody that you've named in your estate plan, your living trust or your will, to handle things when you can't. If you leave this earth or you're mentally incapacitated, this is a great opportunity to, number one, ask questions, but also we've got some great content coming up because this is really, really important because guess what? It happens to everyone, right? It's the price of living. Everyone dies and you don't take your stuff with you and someone's going to have to deal with it. Well, if you're watching this this brings us to the end of our webinar. If you're watching this on YouTube, stay tuned because there's another video on right after this one.